Welcome to Reka's Forex Academy. This is part 2 of a series of lessons RFA is giving out to the audience. Part 1 was basically on introduction to foreign exchange trade, and this part 2 will be based on chapter 1 of the 5 chapters that we earlier talked on. We talked on understanding Forex, chapter 1, chapter 2, brokers, website and platforms, chapter 3, understanding MT4 trading platform, chapter 4, Forex market analysis tools, and chapter 5, financial management. In today's lesson, we're going to focus on understanding Forex. What is Forex? What is traded in Forex? How big and liquid is the Forex market? Where and when can you trade? And why should you trade in Forex? We're going to look at Forex traded pairs and rates. What is Forex? Forex simply means foreign exchange trade, denoted by FX or simply Forex. Forex is a global market for trading the world's currencies, and today it is the largest financial market in the world. The main participants are the larger international banks and the brokers or dealers. Forex trading is the simultaneous buying of one currency and selling another through a broker or dealer. Currencies are traded in pairs. For example, you have the Euro USD, the USD Japanese Yen, the Euro CAD, and so on. So, brokers are the go between the larger international banks and the traders, offering to the traders a series of services through their websites. We can consider Forex currency pair as two entities that are always in a tug of war. In this case of a currency pair, each currency on its own side pulls the other currency. And when they do that, exchange rate fluctuates based on which currency is stronger. The strength or weaknesses of the currencies comes as a result of short-term demand and supply, reactions by traders to economic news, interest rates, and the balance of payment position between the two countries whose currencies are involved in the trade. What then is traded in Forex? The simple answer is money, because there is nothing physical that we are buying or selling in Forex. Think of buying a currency as buying a share in a particular country. The price of the currency is a direct reflection of what the market thinks about the current and future health of that economy. In general, the exchange rate of a currency versus other currencies is a reflection of the condition of that country's economy compared to other countries' economies. What else is traded in Forex? Apart from currencies, we can trade stocks, indices, futures, precious metals like gold and silver, commodities like crude oil, copper, cotton, cocoa, natural gas, and so on. We can equally trade cryptocurrencies. The foreign exchange market brings about a lot of movement in currency flow between nations as a result of interaction by traders, always making deposits and withdrawals from the market. And in a day, the foreign exchange market can pull $5 trillion compared to stock exchange market. It would just be something like one tenth of the money stock Forex trade can pull per day. In Forex, currencies are grouped into two major groups: we have the major currencies and the exotic currencies. There are 8 major currencies: USD, EUR, JPY, GBP, CHF, CAD, AUD, and NZD. The country name or initials denote the first 2 characters of the symbol of the currency, and the last or the third character is the currency. For example, USD stands for United States, US stands for United States, and D stands for the dollar. The exotic pairs, as we are going to see, do also respect the role of 3 letters, first 2 denoting the country's initials and the last the currency. When we trade 2 currencies, or when we trade currencies in pair, take for example the Great British Pound versus the US dollar, the first currency in the pair is often referred to as the base currency, and the second currency is referred to as the term or the quote currency. If Great British Pound versus USD has the exchange rate or the price of 1.69541, it simply means 1 British pound can buy 1.69541 US dollars. We're going to see this when we start showing you through the MetaTrader 4 platform where trade is being done. The exotic pairs and the major pairs are paired following some criteria. When the pair is involving the euro is always acting in the place of the base currency. And when the pair involves the Japanese yen is always acting as a quote currency. The other pairs, we are going to see how the pairing is done when we start showing you through the MT4 platform. Similarly, Canadian dollar versus Japanese yen, if the price is quoted as 107.195, this simply means 1 Canadian dollar can buy or will buy 107.195 Japanese yen. We are going to see as we move on that when the price involves Japanese yen, it is always rounded up to 2 decimal places, and elsewhere it is 4 decimal places. We're going to do this as soon as we start looking at currency pair and the pips value. What about exotic currencies? These are non-major currencies. Examples may include the Singapore dollar, the South African rand, and so on. Pairing with the Japanese yen follows the same principle. The Japanese yen serves as the quote currency. How big and liquid is the Forex market? The Forex market, as we have said earlier, is the biggest financial market, and it is referred to as over-the-counter market or interbank market, since the entire market is run electronically within a network of banks, and this takes place continuously for 24 hours period and for 5 days a week. Usually trade opens on Sunday midnight or probably Monday in the morning and runs through Friday midnight. So we can trade Forex from any point of the globe. Where and when can you trade? As earlier said, we can trade Forex anywhere on the globe. All we need is a computer device and a modem equipped with internet. Forex can be traded round the clock, 24 hours on 5. The trade runs from Sunday evening to Friday evening or by midnight. So when we start trade, we'll take into consideration certain time zones. For example, if we are trading the Japanese yen between 00 GMT to 09 GMT, we know the market is active at that time because the banks are open. Similarly, with the London and EU zone, between 8 hours and 17 hours GMT, the market eventually will be very active. And when we're trading the US dollar, we have to take care of the time zone also, where the banks are active between 13 hours 30 to 22 hours GMT. Why should we trade in Forex? Usually, all traders or businessmen will look for such opportunities where they will minimize costs and maximize profit. Such is a foreign exchange trade. In foreign exchange trade, we do not pay for publicity. We do not talk about going to work, sitting in an office between 8 hours and 4 hours. We do not have any commitment to travel to work, nor spend on travel expenses. We don't have any customers to entertain. We don't have a product that we are selling. We don't have to worry about failed deliveries. And even if the economy is in a recession, we always make profit out of it. In Forex, we say bad news and good news is good news. The cost that we may incur in Forex trade is just probably internet bills and probably maintenance on your computer equipment. If not, we virtually do not recruit staff to pay wages, nor pay rent for office premises, except you actually need an office to sit there and trade. We don't have to worry about warranty provisions. We don't need any qualification. Anybody can learn Forex. In fact, of the 77 million Forex traders in the world, I believe not up to 10% went through a regular training program like this one you are following. Most probably they download stuff from the internet, read, and start applying. We do not have to pay tax when we are Forex traders, except you are in the country where the second income is being taxed. Forex is virtually an independent trade, transferable. You can teach your child, your brother, the skills when you are old, and they can continue. This is where we come to the end of this part 2. Thank you for listening and following the course. We believe that the course has really helped you immensely, and that next class you will still be with us. Thanks for watching. Stay on.